Good afternoon. Welcome back, everybody, to the newest episode of the PenPodcast.com. I'm your host, Matt Harms, founder of Pen for Hire, where we help interesting people get their words out on paper. And second episode back from an extended break. Couldn't think of a better person to have on for this third season of the podcast than Mr. Rob Ripp. How are you today, Rob?
I'm doing very well, Matt. How are you?
I am fantastic. Thank you. Trying to get back into the swing of this podcasting thing.
Great. Glad to help out.
I'm glad you could be here. I mean, it's funny. At one point, I did like 300 episodes in a year, and then I think season two, I did like 30.
Yeah.
And I've just been kicking the can down the road for season three because I feel like I've spoken more than anyone ever wants to hear from me in their life.
I'm sure they loved it.
Well, thankfully, I've got you today, so no one's got to listen to me because we're here to talk about you and your book that just recently came out.
Yes.
So before we go there, let's let everyone know, give them a little bit about yourself, the Reader's Digest version.
Sure. Rob Ripp, I am the founder and president of Fintelligent. We provide entrepreneurs a fractional financial department, and we do everything from day-to-day accounting to the advisory work. We're known for being analysts, and we work with a lot of founders in that sort of late growth stage, early scale stage, about $2 million to $10 million of annual revenue. And basically, we help them find ways to improve their profitability and increase the value of their businesses. And we do the work. We're part of their team.
Fantastic. So that sounds, I have, as you probably remember, I'm a recovering financial industry
Yes.
professional. Try not to think back on those days too much, but how did you go about coming up with this idea for a book in an industry where it seems like you've got Martha Stewart, Susie, like all of the financial gurus? What was going through your head?
Well, I felt that there wasn't anybody talking to the people that I was working with on a regular basis. And these are founders that are used to solving problems. They're salespeople, they're inventors, they're not accountants. And many times when I would first meet them, the first thing he would say is, "Look, I'm not an accountant. I feel like I should be making more money. I don't have great clarity on my financials. I don't have time for it. It's something I get around to. Can you help?" And the answer was yes. And as I heard this story more and more, what I was hearing was founders saying, "I don't have confidence in my numbers. I don't even know where to start. I don't know where to look for these things. It's hard. I talk to people for certain things and they give me some stuff, but not other stuff. And what would be a good resource for me to go to that just kind of has it all in one place for a person in my position at my stage of growth to figure out what's next?" And so that kind of gave me the idea for a book. But the real thing that drove me to actually go ahead and write it was a member of a mastermind community called Collective 54. And their founder, the person that created it, Greg Alexander, held a webinar in the summer of 2024. So about a year from when this podcast is being recorded. Um, and I said to him, I work in finance and accounting. I don't know who anybody would willingly write a book, but I think I might want to try. And he basically said, "Listen, you know a lot about what you're talking about. People here absolutely need to know about it. You should write a book. I think everybody should write a book." And I got some very encouraging comments from the membership, and I talked to some folks about their needs, and they said you should write a book. So I wrote a book.
I love that. As a firm believer that nothing can be written about too much and books are here to solve the world's problems, I love that you took the plunge. And I know a little bit of the background of this, so I'm not going to let my own
Sure.
knowledge cloud this, but I'm curious because you walked us through kind of this founder's journey
Mhm.
of things we don't know until something goes wrong generally,
Right.
and that's when we're like, oh shoot, I don't know something. So
Yes.
what is one of the biggest mistakes you find in your practice when you're working with founders?
Well, I think that founders don't, they put maybe a little too much faith or a little bit too much trust in their financial person when they know that something doesn't seem right. They're very intuitive folks. And for example, they'll look at a profit and loss statement and they'll see maybe some negative numbers on it, or they'll see something say, this isn't making sense to me. It's hard for me to figure out. And they'll get an explanation, "Oh, well, we've always done it that way." Or, "Oh, we did this, this, and this, and I'll fix it." And there's always some sort of explanation. And like, okay, I've been working with you for a while and you haven't failed me before. But what's happened is that the business has changed as it's grown, it's gotten more complex. And so the questions that founders were asking before aren't being asked now. They're different. They're asking for more intelligence about their financial operation. And they're asking the same person who was basically their bookkeeper. And bookkeepers, they're not analysts, they're not CFOs. So there's a bit of a mismatch there. And I think what founders are looking for is, how do I solve for that? But they don't always know they have a problem. They just know that they're not getting something that they used to get before, and they're just frustrated as to why, like what changed, what happened. They didn't see it as a consequence of their growth.
Got it. So what specifically, what's the kind of target size of a firm that you work with?
Typically $2 million to $10 million of annual revenue. So they've demonstrated market demand. They've got some level of profit. They're reinvesting it in the business. But they come to me because they say, listen, for all the risk that I've taken and the success I feel that we've had, I just don't feel like I'm making enough money. I just feel like, I'm leaving money on the table. I feel like we can do better.
I mean, so that's a really interesting point for anyone that's listening because you like to believe that you read all these statistics about the percentage of small businesses that don't make it through their first year,
Hmm.
how many close in the first 5 years.
Hmm.
So when you get to the level where you've got a small business bringing in $2 to $10 million, clearly the founders are not stupid people. They've done something right to get past the stage that kills most.
So, yeah, the statistic is only 4% of all companies ever created exceed $1 million of annual revenue. And $10 million, I think it's like 1/10 of 1%. I mean, the numbers are minuscule. The math really works against you. And as you had mentioned, half of all small businesses fail within, I think, the first 3 to 5 years of existence. So it's a different game when you're north of that $1 million annual revenue mark than when you're trying to get there. And for founders, they're saying, listen, I need to upskill my systems here if I want to get from 1 million to 2 million, 5 million, so forth and so on.
What are some of the best ways, and don't steal all the thunder from the book because we want people to go and read the book.
Sure.
But what are some of like the quickest off the top of your head, if someone's listening to this, like, gee, I might be that guy who's in trouble. What are some things they should be looking at?
I'm going to answer your question with a question. If you were to go to a new place that you wanted to go visit and you're driving there, what's the first thing you would do?
Well, I would say map, but I'm going to go with the
Use
20.
no map. Just say, yep, you would
Yes.
put something in GPS. Exactly. You put your destination. How do you know where how do you know that you're going to get where you're going if you don't have a roadmap to getting there? And so the first thing we do with founders is we develop that roadmap. Now, our roadmap is a financial plan. And so if somebody says, listen, I want to make more money, I want to do this, I want to do that, okay, we can plan for that. What would your financial statements look like a year from now? And let's talk about what we think is reasonable for our sales and for our profit and for our cash. We'll model all that stuff. But more importantly, we activate the plan because we're meeting with them on a regular basis. We're going through it every month and we're measuring and we're organizing. And if you look at every great company that's ever grown, and even you look at the big companies today, the Magnificent Seven, the tech companies, they've got very rigorous standards around, planning, holding people accountable to the plan, measuring results, going back and changing things that aren't working because the financials tell the story. They are the result of your efforts. And so we have anecdotal and direct data, evidence of people when they follow a well-crafted financial plan, they do better. They make more money. They, exceed their sales. They add more value to their companies. It's a financial plan that makes the difference. That's the one thing.
What are some of the challenges you see with people following that plan?
Well, the first thing is that when people try to do it on their own, they lose interest. It's hard. And people will try to do a P&L, they'll try to do something on spreadsheets. They're kind of taking things that are in their mind and then maybe grabbing some data from QuickBooks or something. And it's tedious and it's just hard to do. And after a while they give up because they want to go make a sale or they want to go work on their product. They've got to run their business. And then maybe they'll try to delegate it to somebody who really doesn't quite do that, like their bookkeeper. Hey, can you, kind of do this for me? So it doesn't lend itself well to do-it-yourselfers. Now, AI might change that. We haven't seen it yet, but it's just a struggle for them to kind of get their hands around it. And if they do finally kind of wrestle their way through it, maybe they get a pretty good P&L, but they don't necessarily know what their cash is because cash is what you have to get from your balance sheet, not your profit and loss statement. They're two different things. And so that's when it really kind of starts to blow people's minds.
God, and you hit something that I found revealing, revolution, maybe not revolution, revealing,
Revelatory. Yeah.
while we were working together is you said they go to their bookkeeper.
Hmm.
And prior to working with you, I never really, and again, I'm someone who has a finance degree,
Sure.
never really thought to differentiate bookkeeper, accountant, controller, CFO. It's kind of like to the layman or the moderately educated, like they're all kind of interchangeable, but they're not, are they?
No, they're not. And we see that mistake all the time because people think that they're interchangeable. And again, they don't know how to define them. And so the way to define them is a bookkeeper follows a process. They're very good at entering transactions from a bank, from credit card statements, and they'll follow it. But they don't create the process. And they can tell you why they put something somewhere, but their research kind of stops there. An accountant will develop the process. They've got more skills, and so they'll develop a process around it. They can do some research on transactions. They'll do things like say, hey, somebody sold you something with a 12-month contract. We'll talk about how we can recognize revenue, more sophisticated kinds of things. A controller assembles the financial statements. They're a great accountant. They supervise accountants. They're very, very good at telling you what happened today and yesterday. But don't ask them to tell you what's going to happen tomorrow. That's the CFO's job. The CFO is strategic. They'll tell you what can happen tomorrow based on all the work that the controller and the accountants and the bookkeepers have done.
So at what side, because I mean, as a business owner myself, it sounds like that's a lot of salaries that start adding up, right?
Oh, it sure can. Yeah, and that's why what people will do, they'll fractionalize it. They'll invade, they'll ask somebody to come in and just do it part time. And a lot of times, people don't need a CFO to even do that kind of work. You can do work with accountants, with analysts, things like that, part-time controllers. You have to be somewhat judicious to do it. But if you want to start to move forward with making your financial operation work better for you because you're now in this $2 to $5 million business, let's say, you do have to make an investment. You do need trained people that are going to set up and maintain the system for you. But that investment doesn't have to be as high as a full-time CFO or even a full-time controller. And a lot of times these people can bring their technology stack, their processes with them. So they're kind of running it. If you're willing to do things, their way, you can get things done very affordably, and surprisingly well because of all the cloud apps and AI and other sort of technological things that have been introduced over the past couple of years that make it easier for folks like me to do this kind of work for other people in the first place.
What's the cost of not doing it?
Well, so soft costs, lost sleep, anxiety, economic opportunity cost, deals you're not getting, things like that. Hard dollar costs, I mean, look, I've seen people that have come to me, where I'll call the end stage of their companies. Too much debt, no cash. They simply cannot sustain what they've got. The owner has run out of personal capital, to keep this thing going. And I'm like, I can't financial engineer a solution for you. Companies close. And so, there is a cost. It depends on the situation. We've seen situations where for maybe $1 or $2 million companies, we put that cost at maybe 10 to 15% a year, so 100 to $150,000, cash in your pocket. To give you an example, we work with a lot of companies that are professional services providers. And one of the things that surprises us is we see how much staff they have and how many subcontractors they have. And we find out that their staff is really only working on customers like half the time. And we're saying, well, why do you have all these subcontractors and your staff basically only working every other day? Why not have your staff work more? Get rid of the subcontractors. We see that, we make those kinds of recommendations, and all of a sudden they've dropped 50, 100, $150,000 right to the bottom line. So when you have somebody who's trained and has seen these things before kind of coming in, making these recommendations, it's somewhat obvious to folks like us because we see it all the time. But sometimes for founders, they really need to be convinced, especially if some of these people that they need to say goodbye to have been people that got them to this current stage of growth. And so sometimes those can be hard conversations.
What are some of like the biggest successes you've seen from working with companies?
Well, I mean, I've been with people where I was the fourth resource brought on board, and within 3 or 4 years, they had raised over $100 million from a private equity company. I've seen people with eight-figure payouts. I mean, I've been, as virtual CFO, the person that prepares the closing statements, the payment statements with the wire transfers and the amounts. So when the close happens, things happen. That's when the magic appears. I mean, we talk about, we read about in the press, people selling their company, having all this money. Well, we're the ones doing the mechanics of all that and making that happen through helping people, customers of ours sell their companies. So it really kind of runs the gamut. But I will say the people that I've seen be very successful at this, having something in common. They're very deliberate about it. They're very deliberate about exiting. They had a plan. They hired advisors. They spent what they had to make sure that they would make it through due diligence. And they'd spent years preparing their companies to be sellable. And so that is very, very important as opposed to somebody who just happens to sell their company because they had a friend in the business or a partner or something like that. The people that were deliberate about it tended to have a much bigger payoff.
So you hit on something that I think a lot of business owners either don't think about because they're too busy struggling in the moment,
Hmm.
or they're too busy. They've hit that point where they just love what they're doing, that retirement or selling doesn't even enter their minds. But at some point, I like to believe either your exit strategy as a founder of a business is either give it to your kids, which nowadays, who knows, your kids are going to want to do or capable of doing what you want, or to sell it. So, what are some of the ways that you help people get that company ready to sell where a buyer doesn't come in and go, oh my gosh, you guys are a train wreck?
Well, I think it starts with everybody, every business owner has to recognize they're exiting their business whether they want to or not. It's just going to happen. And there's really kind of, two things to consider. People either sell their business because they want to or because they have to. And when you want to, you're going to get a much better deal than when you have to. So what does that look like? And what does it look like to actually kind of get that premium valuation and how do we help? Ultimately, what you're doing is you're convincing an investor that this company you're buying is worth it for them to purchase. Because keep in mind, a lot of investors, let's say private equity folks, they see hundreds of deals a year and they're working and they're going to close very few. So you're competing with their deal flow. You're also negotiating against somebody whose job it is, who's made their career of getting the best price possible. And as a founder, you're going to sell your company only once, and maybe you do it a couple times, but that's it. You'll never be able to kind of match them in terms of, pricing, strategies, negotiation, and things like that. So what you have to do is come prepared. And we've seen people that have been represented by an M&A advisor, an investment banker, do much better because that person will advise them on these are the things you need to do. Our role is to have the investor as confident in the acquirer's numbers as the founders that we work with. And we do that through a rigorous due diligence process by, having the numbers accurate, timely, vetted. We manage something called a data room, and there's just lots of information that has to go into that that's being required from the investors. And then we also speak the investor's language. So we understand things around, valuation, multiples, financial projections, cash flow, things of that nature. And so our job is to equip them with information, but also to be able to support the story that the founder is trying to tell about why this business is valuable, why they should get good terms, and why this business makes sense for that acquirer to purchase the way they said they did in the letter of intent. And so, our job really is to close the deal. We work with management. The investment banker will negotiate the deal, and the founder will basically sell the deal. Here's why you need to acquire us.
So, one of the things I heard there, is kind of a recurring theme that in order to do better in the long run, it's better to pay professionals instead of trying to do these things yourself.
You have to pay professionals, and then there's another thing too. You call it the founder bottleneck or the founder trap, and this is where the founder, let's say, owns the entire sales process. And so if the founder goes away, sales dry up because it's based all on relationships. That's a big risk factor for an investor. They don't want to see that. They want to see like a strong number two in place. In fact, they want to see a firm that can basically run without you. And so companies that are too dependent on the founder, they may get a decent enough valuation, but the terms aren't going to be good, and the terms matter in a deal. And so, in the situation I just described, what would typically happen is that the acquirer would require the seller to be on an earnout. And they'd say, listen, I'm going to pay you over some number of years, maybe 3 to 5 years, based upon you hitting certain targets. And I think there's a number, maybe 80, 90% of all earnouts are not fully paid out. They just don't work. And anybody who's selling their business, even those that know that they're going to be subject to an earnout, will basically say, listen, when I sell this business, the cash that I get at the close, I'm going to plan on that being all that I get. I'd love to get more, but I'm probably not going to get the whole thing. And that's a lot of money to leave on the table, especially if you've been building something for 15 or 20 years.
So that you just that time frame just put a question in my head. You've gotten to this point, right? You're 15 years invested. You go to make that sale, and now you get these terms where you, half of your money is potentially at stake over the next 5 or 10 years,
Yes.
unless you hit these numbers. So let's say you find yourself in that position, and you're like, I don't want to do this. I'm going to go back and fix everything. And
Hmm.
this might be a broad brush question.
Sure.
How long is someone gonna have to go back to the drawing board, engage you and your team before they can get to a point where they're not in that position?
We're going to say 18 to 24 months. And again, it depends on how far off they were in the beginning. I mean, we've seen deals collapse because the investor literally said, I can't make heads or tails of these numbers. Like they just don't make sense. The founder doesn't make sense, doesn't know them, fix it. And so, the fixing part itself, we can get done in a quarter or two, even less. I mean, it depends on what's really kind of going on. But it's getting things to stick. It's getting that regular rhythm of finance because finance is a rhythm, right? It never goes away. There's always bills to pay, payroll to make, cash to collect. But that data tells a story. And what we want to do is tell that story of increasing revenue, increasing profit, and increasing cash flow. And you want it increasing rapidly. And investors screen for this. Investors use something called the rule of 40, which is sort of a simple metric that says, listen, if you take your average annual revenue growth rate and your EBITDA, your profitability, your operating profit essentially, as a percentage of revenue, and add them up, that number should be 40% or more. So if I have 20% revenue growth and 20% EBITDA, that's 40. That's the minimum where they're going to start. If you're exceeding that, that's better for you. That you're more attractive to an acquirer. And so if you're going to have that kind of revenue growth or that kind of profit growth, you better have a financial infrastructure that's capable of communicating to you that you're actually achieving that growth consistently. Otherwise, you're not going to get it. And you're certainly not going to be able to convince others that you have it because you don't have mechanisms in place to report it and more importantly, to act upon it. And so that's what we try to do is we put those systems in place because again, it's deliberate. If we know, for example, we're hiring they have a salesperson, that person's not making their quota. We said, hey, after 3 months, we're going to reevaluate. Well, for measuring that, then maybe you have to let that salesperson go and bring somebody else in who's going to hit their numbers. That's how companies succeed. That's how companies do these things. Those are the trade-offs that people make. And when you follow that kind of plan and that kind of thinking, that kind of analytical approach, it always pays off. Because the story is in the data, and people who are acquiring you expect you to have that already done when you come in because they don't want to rebuild those systems. They want to expand upon them. They want to have a great innovator and then plug it into a distribution system and just have it go because they can handle the scale. They don't want to have to go and reinvent all these kinds of things because a lot of times these buyers, especially financial buyers, they're not operators. They don't know how to run a business. They know how to sell it. And so they want to have you run it for a few years and then sell it again so they can make more money. And it's say at least half the market are these financial buyers, as opposed to strategic buyers who know how to run your business and are just looking to grow their own.
Love it. And the way you just succinctly put that together kind of segues into one of the last things I wanted to ask you. And this is an unfair question, which is why you're going to answer it. I'm going to stay quiet because I know. But when you think about finance books, and I've read a lot, I've worked on a lot, uh, you either wind up in this position of you just wrote a textbook and now you hope someone can go and dissect it and find anything they can put into practice, or you've kind of written this lofty head in the clouds like 30,000 foot overview where there's nothing material anyone can do with anything because you tried to make it so that everyone could understand.
Yeah. Yeah.
So how did you go about putting together this book in a way that you would appeal to your target reader, who are obviously founders, people who are going to look to hire you for your services, as well as anyone else who's maybe getting to that point of things they should start doing now?
Sure. So, of all the business books that founders want to read, I'd say finance and accounting is on the bottom of that list. I mean, and we know what all the good books are. And so I said, listen, if I'm going to ever be able to break through that, I have to tell a story. And I have to tell a good story. And I have to tell a story that a founder could really identify with, kind of see them in that position. And so I created this character called Lindsay, and she was a business owner, and she was doing well, not great. And she tried to sell her business and failed at it. And the investor said, "We don't know your numbers, and we don't think you do either." And she was devastated because, up to this point, she in her mind was killing it. And so she said, "Well, if I don't want to go through this experience again, I've got to take a hard look at my financial operations and change it." And so I wrote a book about what that change looked like, and I wove in the things that we do in finance with her story and with her narrative. So, what was her first management meeting looking like, and what kind of analytics did we put in there, and how do we kind of set these things up, and what was she going through in her mind as she was going through these changes? Because, she had a loyal staff member. How was he going to take it, bringing these other people in? She had to make a big investment, in these new systems and people and in her own growth, and she also had to get over her own um, fear and sort of discomfort with her financial knowledge. She knew that what she didn't know, but she was used to figuring things out. And founders have a lot of pride in that. And I've talked to more than one founder who has a little bit of shame around, I should know this better. How come I don't? And what she needed was a guide to just kind of filter things out and show her these are the things you should worry about. Don't worry about these things. This is what we're doing. Here's what's important and why. And at the end of the book, the final chapter, which I loved reading and writing and still read every now and then, shows the payoff. How does it all kind of come together? Getting back to your questions before around exit, and how could this actually be meaningful and worthwhile to her? Would it work? And the book is sort of a real life depiction of it working, because the things that are in the book come from my experiences, having worked with many founders at this point, helping them grow their businesses so they could sell it.
I was just going to say, you kind of alluded to it right there, but kind of like the Law and Order disclosure. Lindsay is a fictional character. However,
Yes.
the events that happen in the book are far from fictional.
Yeah, no, it's patterned on things that I've been through. I mean, certainly the scale and those kinds of things, but everything in the book are things that we've done, things that we've participated in, deals that I've helped close. It all comes from real life. So yeah, this is not made up stuff. I mean, these are things that actually happened, um, told in a story format. It's a composite of a number of different things kind of brought into a single story. But yes, this is how it works. And I would say to people who read the book, ask your founders, ask people who've sold their businesses whether this kind of sounds right, because I've gotten some feedback from founders who have sold their companies like, oh, this takes me back. I remember what due diligence was like. I remember how I felt when I got the wire transfers. Some of the things that I did, you put in your book, I know I had to do and we did. It made a difference. And that's very heartening because I had some people that had already completed that journey at least once give me some great feedback, as well as people who are on the journey saying, wow, I now know how far off I am and what I need to do to get back on track. So there's that part to it as well.
Love it. Rob, we're just about at the end of our time together, but please don't me cheat you of the opportunity to tell everyone the name of the book, where they can find it, how they can contact you.
Sure. So the book is called Finance for Founders: The Journey to Unlocking Your Company's Wealth. Best place to get it is on Amazon. We have it available, Kindle and paperback and hardcover. We are coming out with an audiobook, probably end of July of 2025. And my company is Fintelligent, and we can be reached at fintelligent.com. That's Fintelligent with an F. And you can learn more about me and the company and what we do for founders.
I love it. So for everyone listening, book first, personal recommendation second, go read the book. If you have any question about anything that was just spoken about in the last 30 minutes, I assure you, it's a quick and easy read. It's informative, really draws you into the narrative of at points you find yourself rooting for Lindsay. At points you're going to find yourself, if you are a business owner, hoping that you don't wind up where she started. You
Yeah.
do want to
Yeah.
wind up where she ended. I'm going to stop there so I don't
Yeah, yeah.
ruin the
It
middle.
does, and it does have some tools and assessments in it too. So it has some free resources that if you ever wanted to know what should a good chart of accounts look like, or what should my financial statements look like, there's ways you can link to resources on our website. You can download that and get those resources for free. So there's some free
Fantastic.
tools in there too.
Yeah, oh, free tools are always great. I highly recommend, again, as a founder, as someone who's worked in finance, who worked with Rob very closely on getting these concepts out. If you're running a business anywhere near that size, reach out to Rob and his team. Really, the book is just an extension of everything that they've done, and books are great, but work with the expert brings even more value. If you have any questions, you can just reach out to me here at the show, Matt at penforhirenyc.com. Happy to answer them. Happy to point you in Rob's direction if you didn't catch the Fintelligent.com. And we will catch you all in the next episode. Really appreciate you tuning in. And Rob, thank you so much for your time today.
Oh, it's my pleasure. Thank you.
Absolutely fantastic. Thank you.
Okay, take care.